Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. This will be my second in a long series I'm doing where I'm covering each of the sectors in the marketplace and looking for value. As a value investor, I often talk about the fact that it's a market of stocks and not a stock market. And what that means is that no matter whether we have a bull market or a bear market, there will always be value to be found in any market, regardless of its current status. Now, having said that, I'm looking for value here, and I'm going to be designing using the screening tool of the FastGraphs research tool that I co-founded, and we're going to be looking for value in all these various sectors. But just because we find value, I do want to caution you, does not mean it's a good investment. So I'm looking for research candidates or companies in these sectors that meet certain screening criteria, which I'll go over with you, that also look to be in value. But then we have to determine from there whether they're a good investment or not, whether B, they fit your goals and objectives, and C, whether they're worthy of your time to go ahead and look a little deeper. So let's go ahead and move into the FastGraphs research tool now, and let's start with the screener and how I defined the screens that I'm going to be talking about here. All right, I'm in the FastGraphs screening tool here, and I've created a general screen here called Communication Services, and I added the word total return. But I'm also looking for dividends. So the first thing I want to do here is I want to go over this screen with you and make sure you understand. One of the things that happened in the first video, people asked me why certain stocks weren't considered. Now, the simple answer is they didn't meet one or more criteria of the screen. So the screens are very specific. Now, we can adjust these a lot of different ways, and I'll show you that. I'll show you one example of that as I go through here. But what I've done is I've got 6 general items. I've got 1 historic item, 2 estimated items, and 2 regions picked in this screen. And this is important because the regions are only US and Canada. So let's go into the general section. When I go into the general section, first I'm looking for the sector that I'm going to be talking about. I'm doing communication services today. I'm also looking for primary tickers. I only want tickers in the countries rather that I'm doing business in. Then as far as earnings, I want to look at earnings a little bit. I want an earnings yield of 6% or higher. I like 6.5% typically, but this lets me find companies that are already in value or close. I want to see what the PE ratio is when I go ahead and get the screening done, when I look at all the different companies. Now, I also want an adjusted earnings per share persistency score above 50%. Now, by doing that and running the query up here with some of the other screening components, which I'll come back to here in a moment, if I run the query, I get 12 companies. What I wanted to point out is if I just change this one screen and look for 60% persistency, meaning that earnings grow 60% of the time. So that would be companies that have more consistent earnings, and I run the query that now currently has 12 stocks, that cuts it down to 8. Okay, so I do want to make it clear that just little tweaks in the screening process will make differences in the number of candidates that you're going to get. And I'm trying to come up with manageable numbers, at least for the sake of these videos. Okay, now on the estimate section, I've got 2 things that I'm screening for. I'm looking for a total rate of return greater than 5%. I'm not trying to look for real high rates of return here. And I want positive earnings growth. All right, those are the 2 things that I'm looking for in this screener. All right, now this is important. For as far as regions go, I'm only checked US and Canada. So I'm only looking for companies that are in the US or Canada. Okay, and you can see that here on the report here. The regions are Canada and US only. These are all communication services companies. They're all primary tickers. 11 of them have a dividend yield, 1 doesn't. And they all have PE ratios that are below 15, which gives them an earnings yield that's above 6, actually 6.5% in this case. Well, with the exception of Wiley and Son, it's only got a PE of an earnings yield of 6.22. This is where I see the sweet spot of value, is why I'm doing that. The earnings persistency scores are all above 50%. Again, with Wiley just barely, and Comcast is just barely, but they're all good persistency. They've got estimated EPS rate of return. So I'm looking for a gross rate of return here of these various numbers, with John Wiley and Interpublic having kind of low numbers and BCE having kind of low numbers. And then I'm looking for EPS compounded 5-year historical growth rate. And I've got 3 of them that have negative historical growth rates, but that doesn't necessarily throw them off of the tool. So we're going to go through these here. But before I do, I want to go back into this idea of it's a market of stocks, not a stock market. As I explained in the last video, the blue line on this graph in this current iteration or time frame is a PE ratio of 18.91. That's a trimmed average of what the market has normally valued the SPY at. Now, that's a reference, okay, because clearly, if I'm looking at the stock price, which is the black line, being below the blue line, it's a PE ratio lower than 18.9. If I see it above the blue line, it's a PE ratio, in this case 21.38, above the line. Okay, but you can see that there's a general easy statement that says that the SPY trades between 15 and 18 times earnings most of the time. In this last recent period coming out of the Great Recession, it's been closer to 19 times earnings or higher more often than it's been 15 times earnings, but it was 15 times earnings for this period of time. Now, this is real-world evidence. Okay, I had one comment saying that a 15 PE for the S&P was ridiculous. Well, it's not. It's been the 200-year average is somewhere between 15 and 18. But that doesn't mean that there won't be times when it gets above that, like it did in 22 or 23. And we got an S&P 500 with a long-term growth rate of 7.8% over this time frame going back to 2003. But we also have double-digit growth expected going forward. When I look at the Russell 3000, I've got a very similar growth rate, but here we've got significantly more constituents in here. Once again, I've got the blue line here is 19.59, just slightly higher than the S&P. But again, you see the same characteristics most of the time, or a lot of the time it trades between this 15 to 20, we'll call it 20 multiple, which is the blue line. But then again, it's also gotten way above that, but we're not expecting as much growth. So my point is, I believe these major indices, as measured by those 2 ETFs, are very, very highly valued. But in that, there are stocks within each sector that are not overvalued. None of these stocks have PE ratios up in the 25 range. I want to make that clear. So let's go through these research candidates real quickly, and then I'll let you decide if any of these are stocks you might want to look at. And there's some interesting choices here. The first one I'm going to look at is Stingray. Okay, this is a Canadian broadcasting company. As I pointed out in the last video, you can go to the corporate website off of FastGraphs and kind of see what businesses the company's in. Okay, so it's streaming and distribution, it has advertising, it has radio, and so on. So you can spend your time, if this stock would appeal to you, you could spend your time evaluating it. Now, there's some interesting characteristics about Stingray that I think you ought to be aware of. First of all, they must have gone public in 2016, so we have a relatively short history. As it first came out, it was trading at multiples of 17, 18, and so on, but then coming into 2018, the stock price started to fall below the orange line, and it stayed below the orange line for all these years. So if I take some time off of here, we can see just by shortening the time frames that we're down to a stock that's been trading more like an 8 PE, although fair value at a growth rate of 6% in this example, or if I go to the 8-year graph, a growth rate of 9% would indicate a 15 fair value, but it's trading at a discount. So if I was going to invest in this company, I would be focused on being very conservative, trying to make sure that I get a low PE. So when I go into the forecasting calculator, rather than calculate my return potential based on the 15 PE, which it has traded at in the past, I do want to point out, these would be very, very strong rates of return this company could generate. But if I go to the normal multiple, which has been 8.46, I still get double-digit rates of return. So this looks very attractive. I've got a 3.88% dividend yield, which is very attractive, but I would also point out, if I'm a dividend growth stock investor, this company's really kept a flat dividend all these years. So we're not getting any dividend growth, but we are getting a decent yield. So this looks almost more like a bond from the income point of view, or a fixed income like a CD, than it does a dividend growth stock. But on the other hand, by looking at the capital appreciation, I've got almost 4% dividend income and 8% growth. That gets me around a 12 or 13% rate of return, which is exactly what Stingray is showing to offer. But again, I would be looking at this company as what I would call a blue line company, but it's been around at 8. Keep in mind, as I adjust the time frame, this shows a 10 multiple, but as I adjust the time frame to 8 years, I'm getting that 8.46 multiple. Okay, so that's Stingray Group. The next company on the list is Quebecor, I guess that's called. It's also another Canadian company. It's had a very strong historical growth rate. It didn't pay much of a dividend. The white line on the graph is the dividend, and if you point to the dots, it tells you the payout ratio. So you can see it's only been paying out teen digits, single digits occasionally of its dividend, but then they started increasing their payout ratio really probably in 2017. 2018 got up to close to 10, then to 17, then to 34, and then 43, and that's about what it's paying now. And you can see there was a green light shaded area here, but it wasn't throwing off much dividend, but it's now yielding 3.6% dividend yield. It's got a earnings yield of almost 9%, a blended PE of 14. It does have quite a bit of debt, I might add, but one of the things I want to look at with an income producer like this, what about the cash flows? It's got very substantial cash flows covering it. I want to see this orange line, which is operating cash flow, be significantly above this white line, which are dividends. And the real test is free cash flow. And when I look at free cash flow, I get that same picture. So the dividend appears to be very safe, even though the company does carry with it a lot of debt. So now when I go into forecasting here and look at the forecasting, we're not expecting much growth going forward, only about 3%. It had 12% growth in 2023. It's expected 5% this year, 5% next year, and then only 3 analysts are forecasting 1% for the following year. If I look at the long-term growth rate, I don't get one, but the historical growth rate has been about 8.74. These calculators allow me to run different scenarios, best case, worst case, mid case. So using the normal multiple on this stock of a PE of around 12.5 and a growth rate of 3.7%, I would get double-digit return potential here with a 3.76% dividend yield, as I've already discussed. The next company on the list is also a Canadian company. It's BCE Inc., and it's had relatively low growth rate, but it's also had a very high dividend payout ratio. So I really want to check operating cash flow here. And again, the operating cash flow is substantially above the dividend income. The free cash flow is also generally above, but it's getting closer at times. Okay, so I'd call that a caveat. It has about 55% debt to capital. It has an earnings yield of 6.73%, which is attractive, a dividend yield of almost 9%. Okay, so now when we're looking at forecasting here, and we're looking at 2% growth, a PE of 12 would be fair using a kind of a Graham-Dodd discounted present value formula. Again, a PE up here in the 15, 16 range. This would be 15.41, would give us a 12% rate of return. If we went on the normal multiple, which has been about 17, it could give us a double-digit rate of return. So it looks like this would be worth looking at more. We can see that it was overvalued looking at the historical graph in 2019, 2021, 22, and then it's come down to where it's fallen below the blue line. Obviously, the Great Recession would have been the best time to buy a stock. Now, with fast graphs, you can calculate rates of return adjusted for value. Here, we'd have had about a 9% rate of return after this drop. But I do want to point out that valuation matters, and it matters a lot. At the peak value, it would have been almost a 12.5% rate of return. So again, it's now fallen. The market has put a general premium on this stock for most of this last couple of decades, but that's something you'd want to take into consideration. Now, one that I am long in is the Omnicom Group. It's an advertising company, U.S. company. It's got very persistent earnings growth. During COVID, it had a little drop, and it had a little drop during the recession, but otherwise it's been pretty consistent grower. Forecast growth is expected to still be about 8%, and that would easily justify a 15 PE, which would give us a 19.47 annualized rate of return, just under a 47% total return. Putting a normal multiple on here of 12, being very conservative, I would still get the opportunity to generate just under a 9% rate of return. It's got a 2.75% dividend yield. It's got 59%. It's BBB plus rated. This looks like a very nice candidate. And I do think the stock is reasonably valued based on its current forecasts and so on, which are strong at 8%. This should bring it back to a 15 PE, in my opinion. The next stock on the list we want to look at will be Shutterstock. Now, this is kind of interesting. Shutterstock was a no-growth situation for all these years. I do want to point that out. It had periods where it grew strong and then had dropped, but we didn't really get a lot of growth. We had 90-cent earnings in 2013 that only grew to $1.23 by 2019. But along came COVID, and we had this more than doubling of earnings, and then we've had very strong growth after that. The company has started paying a dividend, and their payout ratio is in the 20% range, as you can see. As they call it 25%, but they have grown their dividend very nicely. They're yielding almost a 0.75% dividend yield. They only have 17% debt, and it is a small cap. Okay, but looking at forecasts going forward, it's expected to grow at 9%. That would easily support a 15 PE. That could give us 53% annualized rate of return out to 2026. Using a normal multiple of 23 times earnings, that could give us a 90% rate of return. And again, let's evaluate that. The market has put a high premium value, but for the last couple of years, and once they started paying a dividend stock, the stock was overvalued during this period. It now looks like it's very undervalued. So if I shorten this time frame significantly, I've got still very strong growth and a very, very low multiple, and I've got very low debt for this small cap company. This could be a very attractive situation for those who are willing to look at a stock. Now, they just started paying a dividend in 2020. So that's Shutterstock. Verizon and AT&T I've done videos on in, I think it was July 18th of 2023 that I did a video on these stocks, and the performance has been really strong since. I got a lot of heat, but it was a valuation play. I still think it's a low valuation play, not with much growth. And even if you apply a normal multiple of only 10 times earnings, this stock has the ability to generate double-digit rates of return. The PE is currently 9 times earnings. So even at that 9-ish times earnings, we'd have double-digit rates of return potential. All right, so I like Verizon for the 6.5% dividend yield. The next stock on the list is one I probably like the least out of this group. It's got very inconsistent earnings growth, but it does average the 50%. Forecasting, it's expected to grow at double-digit rates, however. The fact that there's no dividend is just there's only one analyst on this stock, so that I don't like that very much. And there's nobody giving a dividend record. So this is something you'd have to dig into yourself to try to learn more. They have a very good dividend record historically, and odds are they're going to continue. Now, I have seen some sources expect $1.41 for April of 2025. They've got an April fiscal year. But again, looking at John Wiley from a forecasting point of view, it does have decent growth potential with a PE ratio of 16 and an earnings yield of only 6.2%. That doesn't give it a lot of juice. And using a more discounted or conservative number, that would only give us a 4% rate of return. But we could be getting a 3 or 4% dividend yield, which isn't being factored in to this number. So, you can see I got 0 for dividends because there's no forecast. So this is one you'd want to spend some time looking at if you like the company. Comcast is inexplicably cheap. It's been inexplicably cheap for a long period of time. It's an A-rated company. Looking at it forecasting-wise, we're expecting 6% growth. That would warrant a 15 PE as fair value, giving us double-digit return potential. Using a normal multiple recently of even only 13.5, that still gives us very strong double-digit 30 and 40% rates of return out for the next couple of years. So I like this stock a lot. I don't know why the market has been beating it up so bad, but even if you look at the last 10 years, the stock has grown at almost 11%, and we've got this period of time. And it's traded at a 15 multiple most of the time, except starting in 2021 through now. But we're starting to see what looks like maybe some momentum building in the stock. So this is one you'd want to take a closer look at, I think. Fox News or Fox Corp, they've been trading at this low multiple of about 11. It's currently trading 11.9 multiple. So looking at forecasting here, the stock's expected to grow at about 6%. At a 15 PE, that would give you a 16% rate of return. At a 11 PE, that would only give you a 5% rate of return. And it doesn't pay much dividend. So this is one that you'd have to decide yourself whether or not the current low valuations are warranted or not, or should it be trading at a higher level based on its growth potential. Company has very modest debt of only 39%. It's BBB rated. So Fox is one that you might want to take a look at. Has a low dividend yield, but there's plenty of room for the dividend to be increased. From a cash flow point of view, the dividend is real strongly covered both in free cash flow and operating cash flow. So that's a plus as far as I'm concerned. So you could take a closer look at Fox. IPG has seemed to run into a little wall of earnings growth here, but historically it's been a 15% grower. We can buy it at really low valuations right now. When you look at it, it's got about 50% debt to capital. Forecasting-wise, analysts aren't expecting much growth, but it does offer a 4.48% dividend yield. And historically, their dividend has grown rather nicely from a standpoint of yield on cost. In 2011, it would have been 1.5%. Last year, it would have yielded almost 8%. So that's what I call growth yield. Some people call yield on cost. So again, it all depends on what this company's growth is going to look like. Long-term growth is expected to be a little better at 2%. Even at a 13 PE, that would give us about a double-digit rate of return. Historic growth has been much stronger. So again, research and due diligence is required here. But this is a very high-quality company with a nice dividend yield and a very low valuation relative to its historical norms. The next one, of course, is Ziff Davis. Now, it was the only one in the group that didn't pay a dividend. They actually eliminated their dividend during COVID. They were paying one for a while. As you can see, the white line, then they cut it, and then they eliminated it. The stock got pretty highly valued coming out of COVID, and it's been in a downswell ever since. Forecasting-wise, analysts are expecting 8% growth, which is a pretty strong number. If you look at the normal multiple, only 12 times earnings, that would still give us 38% annualized rate of return. But with no dividend, everything's about capital appreciation here. This particular stock is all about buying cheap. Okay, buying a stock with a PE of only 7, but an earnings yield of 14%. If this stock, again, were simply to recover back to a normal 15 PE, you'd be looking at 50% rates of return annualized, and that would be very strong. So this would be one you might want to take a look at. And then, of course, American Telephone, same, where I looked at this in July of 2023, where I did a video and I talked about it possibly doubling. This would be about right. This would be right before, and we've had really good performance since. It's been moving towards its normal valuation. It doesn't expect it to have much growth, and from a normal multiple, if it traded at a 8 multiple, it's currently trading at almost a 10 multiple. If that multiple expanded, you'd have a decent rate of return, but you got a 5% dividend yield. And keep in mind, it looks like they cut the dividend here, but that was actually the spinoff of Time Warner that they did in April of 2022. All right, so there you have it, the dozen communication services stocks that screened out of the screens I ran. You can look at those yourself and pick and choose the ones that you like that you might feel that you wanted to look at a little closer. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs, offering the second in my screens on sectors. I do want you to pay attention to screens. Don't ask me why stocks weren't included. They weren't included because they didn't meet the screening criteria. Okay, that's my answer. So if you ask that question, that'll be my answer. You'll see it. But if you like the video, give me a like, ring the bell, subscribe to our channel, and also take a look at subscribing to Fast Graphs because it can really help making this whole idea of investing in common stocks safely and prudently a whole lot easier for you. Thanks for watching, and we'll talk to you again real soon.